Bitcoin just pulled off a move that most traders did not see coming. In a matter of days, the price tore through resistance levels that had held for months, climbing more than 20% off its recent low and smashing straight through its 200-day average, a line that had rejected every single rally attempt since February. That should be the whole story, right? Bitcoin breaks out, bears get destroyed, everyone moves on with their lives, except that is not what is happening. Because right now, in the middle of this breakout, one of the market's most stubborn bears has opened another short position. Not a small one, not a hedge, a real bet that Bitcoin turns around and falls from here. Think about how strange that actually is. 20% higher in a matter of days. Buyers everywhere. Shorts getting liquidated by the hundreds of millions. And somebody, somewhere, just looked at all of that and decided now is the moment to bet against it again. So today we are going to dig into both sides of this. Not a quick take, not a hot opinion, but a full walk through the bull case, the bear case, the psychology behind repeated failed shorts, and the exact levels that will decide who actually wins this argument. And quick note before we get moving, because I want to be upfront with you, nothing in this video is financial advice. I am not telling you to buy, sell, short, or do anything with your money. This is analysis and education built around publicly available market data. So you can think through this yourself and make your own decisions. Please treat it that way. All right, let's get into it. By the way, before we go any further, drop a comment and tell me where you're watching this from and what the weather's like on your end today. I read these, and it genuinely helps me know who's actually here watching all the way through. Now, back to Bitcoin. Let's set the scene properly, because the numbers here actually matter. A little more than a week ago, Bitcoin was sitting in the low 60,000s, grinding through a stretch that felt more like exhaustion than opportunity. Then, almost out of nowhere, buyers stepped in with force. Within a couple of trading sessions, price rocketed from around $62,000 up past $77,000, an advance of roughly 20%, and one of the sharpest short-term moves Bitcoin has produced this entire year. This was not a slow grind either. This was the kind of move that shows up on every trader's screen at once, the kind that makes people who had written Bitcoin off suddenly start paying attention again. Here is why that 20-day, 50-day, 100-day, and 200-day moving averages matter so much right now. Bitcoin didn't just poke above these levels and fall back. It closed above all four of them. The 200-day average in particular, sitting up around $71,500, had acted like a ceiling on every single bounce attempt going back to February of this year. Every time price approached it, sellers showed up and pushed it back down. This time, Bitcoin didn't just touch that ceiling. It broke straight through it and kept climbing. That is the difference between a bounce and a potential breakout. A bounce respects the ceiling. A breakout smashes it and holds above it. But stay with me here, because a 20% move by itself proves almost nothing. Bitcoin has ripped 20% higher before, only to give the entire move back within a couple of weeks. Big green candles feel exciting in the moment, but excitement is not the same thing as a genuine trend change. So here is the real question we need answered. What would actually need to happen for this rally to represent something bigger than a short-term spike? What separates a real regime change from an expensive head fake? Keep that question in your mind, because we are going to come back to it more than once. Now let's bring in the second half of this story, because this is where things get genuinely interesting. While Bitcoin was ripping higher, shorts across the market were getting absolutely hammered. Hundreds of millions of dollars in short positions were forced closed as price kept climbing, each liquidation adding fuel to the very rally that was destroying those positions. This is a well-documented pattern. When a market moves hard in one direction and shorts are forced to buy back their positions to cut losses, that forced buying pushes price even higher, which then liquidates the next batch of shorts, and so on. It is a feedback loop, and it has been running hot throughout this entire rally. And yet, in the middle of all of that carnage, one prominent bear opened another meaningful short position against Bitcoin. After watching short positions get punished again and again throughout this cycle, this trader went back in. Comment below if that sounds completely insane to you, or if you actually think there's logic behind it. I want to see where this audience lands before we get to the reasoning. Because here's the part that doesn't add up on the surface. If repeated bearish bets have been getting crushed, why would anyone willingly walk back into that fire? Is this stubbornness? Is this conviction? Or does this person actually see something the rest of the market is completely missing? The answer isn't simple, and it takes us straight into the psychology of how bears think during a rally like this one. Let's break down the actual psychology, because this pattern shows up over and over in every market, not just crypto. The first driver is anchoring. A trader becomes convinced early on that an asset is fundamentally overvalued, and that belief becomes a mental anchor. Even as price moves further and further away from that anchor point, the trader keeps referencing it instead of adjusting to new information. The anchor doesn't move even when the price does. The second is mean reversion thinking. This is the belief that anything moving up sharply must eventually snap back toward its average. Sometimes this is correct. Markets do revert. But timing a reversion is brutally difficult, and being early on a reversion trade looks identical to being wrong right up until the moment it finally works, if it ever does. The third is macro conviction. A trader might not actually care about Bitcoin's chart at all. They might be betting on interest rates, on liquidity conditions, on the broader risk environment turning hostile for speculative assets. In their mind, Bitcoin is just the vehicle. The real trade is against the macro backdrop. The fourth is technical resistance. Certain price levels carry memory. If Bitcoin previously topped out and reversed hard from a specific zone, some traders will short that exact zone again, betting history repeats. And the fifth is leverage and reward potential. After a rapid 20% move, the potential payout on a well-timed short starts to look very attractive on paper, even though the risk of getting steamrolled by continued momentum is just as real. Here's the uncomfortable truth in all of this. Being wrong once is simply a trade that didn't work out. Being wrong repeatedly in the same direction, against the same asset, can quietly turn into something closer to a psychological trap. At some point, you have to ask whether a trader is reading new information or defending an old position out of pride. But stay with me, because there may be one legitimate reason this particular bear isn't being reckless, and it has almost nothing to do with Bitcoin's chart at all. We'll get there. First, let's actually build the bearish case properly, because it deserves a fair hearing. I want to Steelman this position for a minute, because dismissing the bear outright would be lazy analysis. Interest rate expectations remain a genuine wildcard. Markets have been pricing in a certain path for monetary policy, and any hawkish surprise from central bank officials can suck liquidity out of risk assets almost overnight. Bitcoin, despite its growing institutional footprint, still trades like a high beta risk asset when liquidity tightens. Then there's the dollar. A strengthening dollar has historically applied pressure to Bitcoin and other risk assets, since a stronger dollar tends to coincide with tighter global liquidity conditions. Treasury yields matter here too. When yields climb, the opportunity cost of holding a non-yielding asset like Bitcoin increases, and some capital rotates toward fixed income instead. Add in broader equity market risk, lingering recession concerns in parts of the global economy, and shifting risk appetite among institutional allocators, and you start to see a real, coherent, bearish thesis forming. This isn't nonsense. This is an actual macro argument. Here's the sharpest version of it. If liquidity tightens at the same time investors turn risk off across the board, Bitcoin can discover very quickly that a 20% rally does not make it immune to the broader environment. Price action can change fast when the macro backdrop shifts underneath it. So maybe this bear isn't really betting against Bitcoin at all. Maybe they're betting against the conditions Bitcoin needs in order to keep climbing. That's a subtle but important distinction. But here's where it gets really concerning for the bearish side, because there's another piece of this puzzle that makes the rally look far more structural than a simple bounce. Let's flip the lens now and build the bullish case with the same seriousness. What would make this rally structurally different from previous failed bounces? A few things stand out. First, the nature of the buying matters. Reports around this move point to genuine spot demand alongside the short covering, rather than a rally built purely on leveraged futures positioning. Spot buying tends to represent real conviction, money that isn't relying on borrowed leverage and therefore isn't as quick to reverse under pressure. Second, regulatory tailwinds played a real role here. Momentum around advancing crypto market structure legislation, along with public commentary from political figures supportive of clearer crypto regulation, gave institutional buyers more confidence to step in. That kind of catalyst tends to attract longer-term capital rather than just short-term speculators chasing a candle. Third, reduced selling pressure and improving market breadth both matter. If fewer large holders are dumping into strength, and if the rally is being confirmed by other risk assets moving in the same direction rather than Bitcoin moving alone, that adds real weight to the bullish argument. Fourth, higher lows and a confirmed breakout above that stubborn 200-day average shift the technical picture meaningfully. Breaking a ceiling that held for roughly 6 months is not a minor technical footnote. It's a structural event. Here's the line that actually separates a real trend shift from a dead cat bounce. It isn't how impressive the first green candle looks. It's what happens after all the initial excitement fades and the easy money has already been made. So which is it? Are we watching genuine structural demand, or are we watching a beautifully engineered trap building in real time? Let's talk about how to actually answer that question, because guessing isn't good enough here. Forget trying to predict a number. Numbers are guesses dressed up as confidence. And what actually matters is structure. And there are 5 specific things worth watching closely over the coming days and weeks. The first test is whether Bitcoin holds a higher low not just touches one and bounces briefly, but genuinely holds it under pressure when sellers test it. The second test is whether selling pressure actually gets absorbed. When early rally buyers eventually take profits, does new demand step in and absorb that selling, or does price crumble the moment supply hits the market? The third test is whether volume stays healthy on the way up. Rallies built on thin, low conviction volume tend to be far more fragile than rallies backed by strong, consistent participation. The fourth test is whether Bitcoin reclaims previous resistance zones and holds them as support going forward. Old resistance becoming new support is one of the clearest signs a market has genuinely flipped character. The fifth test is whether buyers keep showing up on pullbacks rather than disappearing the moment price dips. Persistent dip buying tells you conviction is broad, not concentrated in a handful of large traders. If Bitcoin can check these 5 boxes over the coming weeks, the argument that this was merely another bear market bounce becomes very hard to defend credibly. Hit like if you're the kind of person who actually watches price structure instead of just chasing headlines, it tells me who's actually serious about this stuff. Now let's talk about how this could all go wrong, because there is a genuinely dangerous scenario hiding underneath this rally. Here's what a bull trap actually looks like in practice, step by step. A strong rally develops. FOMO kicks in as more traders see the move and refuse to miss out. Late buyers pile in near the top of the move, often using leverage to maximize their exposure. Price approaches a major resistance zone. Momentum starts to fade as the initial buying wave runs out of fresh capital. Leveraged long positions begin stacking up at unsustainable levels. Then, when price finally rolls over even slightly, those over-leveraged positions get liquidated in a cascade, each forced sale triggering the next, sending price down far faster than it climbed. This is exactly why the next move matters, more than the move we've already witnessed. A rally that builds too much leverage underneath it becomes fragile, almost by definition. The bigger and faster the climb, the more vulnerable the structure can become if momentum stalls even briefly. But here's a twist that could flip this entire setup on its head: the short sellers themselves. Follow this loop carefully because it's genuinely counterintuitive. More shorts enter the market. Price continues rising anyway. Those shorts eventually get forced to cover, meaning they have to buy back Bitcoin to close their losing positions. That forced buying adds even more upward pressure. Price rises further. That triggers the next wave of shorts to get liquidated. And the cycle repeats. It's a bit like trying to put out a fire by throwing gasoline on it. Every attempt to fight the rally ends up feeding it instead. If Bitcoin keeps grinding higher while fresh short positions keep entering the market, the bears themselves could end up becoming part of the fuel driving Bitcoin higher, even while they're actively betting against it. That's the paradox sitting at the center of this entire story. So here's the real question. Everyone watching this market should be asking themselves right now, where exactly is the line between a temporary short squeeze and a genuine, durable trend reversal? Because those two things can look almost identical in the moment, and only time actually separates them. Stay with me because we're not at the most important part yet. Let's talk structure rather than predictions. On the bullish confirmation side, we want to see a higher high forming above the recent peak near $77,000, paired with a higher low that holds above the broken 200-day average around $71,500. Add sustained volume and continued demand on any pullback, and the bullish case strengthens considerably. On the bearish confirmation side, watch for a failed breakout attempt, a lower high forming below the recent peak, a breakdown of that newly reclaimed 200-day support level, and increasing selling pressure on any bounce attempt. If those conditions show up instead, the bearish thesis regains serious credibility. Forget trying to guess an exact number for where Bitcoin lands by year end. Watch the structure unfold instead. The structure will tell you far more than any single price target ever could. Let's lay out exactly what would need to happen for this bear to end up being right, because fairness matters here. A hawkish surprise from central bank policymakers could shift liquidity conditions quickly. Continued dollar strength could apply steady pressure. A risk-off rotation across equity markets could drag Bitcoin down alongside traditional assets. A geopolitical shock could spook capital out of anything perceived as risky. Large long-term holders distributing significant positions into strength could cap the rally from above. And excessive leverage building up in derivatives markets could set the stage for a sharp, fast unwind. If several of these arrive together, and there's no guarantee they won't, this 20% rally could end up looking less like the start of a new bull phase and more like the final bounce before another leg lower. But here's the problem with leaning too hard into that thesis right now. If Bitcoin continues holding higher lows, continues absorbing selling pressure without cracking, continues attracting genuine spot demand rather than just speculative leverage, and continues forcing fresh shorts to cover, the bearish thesis becomes progressively more expensive to hold on to. At some point, the real question stops being, why is Bitcoin going up? And starts becoming, how much longer can bears actually afford to keep standing in front of this train? This is exactly where the earlier story about repeated failed short positions comes full circle. Every additional short that gets forced to cover doesn't just represent one trader's loss, it represents fuel being added directly into the rally those very traders are betting against. Let's map out where this realistically goes from this point forward. The first scenario is a genuine trend reversal. Bitcoin holds its breakout, establishes a clean pattern of higher lows, and demand continues showing up on every dip. In this scenario, the broader bear market thesis weakens dramatically, and the conversation shifts entirely toward how far this new uptrend can extend. The second scenario is an extended consolidation range. Bitcoin pauses after this sharp move, trading sideways while the market digests recent gains. In this scenario, neither bulls nor bears have actually won anything yet, and patience becomes the deciding factor for everyone involved. The third scenario is the bull trap fully playing out. Bitcoin fails to hold above resistance, loses its newly reclaimed support levels, and rolls back over hard. In this scenario, the bears suddenly regain full control of the narrative, and this entire rally gets remembered as a trap rather than a turning point. And there's one more possibility that could genuinely punish everyone involved, regardless of which side they're on. Picture extended. Brutal volatility. Bitcoin doesn't cleanly commit to a direction. Instead, it whipsaws, up sharply, then down sharply, then up again, then down again, while leverage keeps building on both sides of the market simultaneously. Eventually, that accumulated leverage triggers cascading liquidations in both directions, wiping out overconfident bulls and overconfident bears within the same stretch of trading days. This kind of environment can create real opportunities for patient, disciplined traders, while simultaneously destroying anyone who entered with too much size and too little room to be wrong. Here's the uncomfortable truth sitting underneath everything we've covered today. The biggest risk right now probably isn't being bullish, and it probably isn't being bearish either. The biggest risk is being too confident in either direction, while the market is still actively deciding which story it wants to tell. Let's come back to where we started. The honest answer is that a 20% rally on its own cannot prove the bear market has ended. Price alone was never going to be enough evidence. What this rally has genuinely done is shift the burden of proof. The bears now need to demonstrate that Bitcoin can actually reverse this structure in a meaningful, sustained way. And if they keep opening fresh short positions while Bitcoin continues printing higher lows, they may end up supplying the exact fuel needed to extend the very rally they're betting against. At the same time, if Bitcoin loses the key support levels established during this recovery, everything we've discussed today flips instantly. The bearish thesis comes roaring back to life, and this rally gets filed away as one more painful trap in a long history of them. That's why the next several candles on this chart matter more than the ones that already printed. They could end up marking the beginning of a genuine new trend, or they could end up being remembered as the most convincing bull trap this cycle has produced. So here's what I actually want from you before you go. Comment below with your honest read. Do you think this bear market is genuinely over, or is this just another sharp relief rally that eventually fades? I'm not looking for hype in the comments. I want your real reasoning, because some of the sharpest analysis on this channel comes directly from this community. And if this kind of breakdown is useful to you, hit subscribe here on the Wealth Continuum, because we track these exact setups as they develop in real time, and the next confirmation on this chart could arrive far sooner than most people expect. Share this with someone who's been arguing with you about whether this rally is real, because honestly, this might be the clearest answer either of you gets for a while. Thanks for sticking with this one all the way through. I'll see you in the next video.